Good afternoon. Today we will look at the current market and a few choices to take advantage of it. I'm Tate with Dakota Plains Ag Center in Napa Junction in Beardsey, South Dakota. It's November 6th and we have our first snow on the ground. Taking a look at corn first, the market is still debating the U.S. corn yield. USDA shows that last week we took out 16% of the crop, putting us 18% behind pace. Locally here in South Dakota, it looks like we're about 31% behind the 5-year average. And the market is debating how this will affect the final yield. We'll go over the USDA WASDE on Thursday, November 9th. Many are looking at the USDA to raise the corn yield by about a half a bushel to a bushel and a half. Moving to beans, harvest is almost all the way caught up on the bean side of things. Nationally, we're sitting at 83% harvested versus 84% 5-year average. Again, all eyes will be on the WASDE coming out on Thursday. The trade looks for the USDA to maybe cut the bean yield just a little bit. Bulls are looking for an increase in soybean demand. They've all been waiting on some sort of an upside breakout to reduce risk from the producer side of things. This report will obviously have an effect on both commodities in the near term. I want to take a look at the longer term though. As we all know, there's a large amount of stocks domestically and globally. It seems as though the South America weather issues have been dissipating, and this puts us into a large carry market. The only way to take advantage is to sell the carry. Looking at making sales. Looking at corn first, we're currently 5 cents away from $4 December 18 futures. Take advantage of this with corn you currently have been putting in the bin. Sell the Dece 18 futures at $4, which is free to do with Dakota Plains. Wait for some sort of a basis pop. I don't think it's out of the question to look for 55 under or 60 under delivered in September. This would lock in 345 or 340 cash delivered in September with your corn that you currently put in the bin this harvest. Moving to beans, it's the same strategy. July beans are currently, futures are at 1020 and 95 under, which is what we are today. This is a 925 sale. We understand it costs more to carry beans, but taking these sales to your banker should make for a better conversation. There are two things that I want to look at here. Number one being, I think the question needs to be, what is wrong with these sales? What would you not like about them? Because today they are realistic and attainable. Number two, selling the carry is not predicting that the market will go up or down. It is taking advantage of what the market is currently giving you. I'm not saying when we get to July, the market will have tanked. What I am saying is today you can make a sale that's 50 cents better in corn and 40 cents better in beans than current market, just by taking advantage of the carry. If you are bullish and think that these sales are too low, I would encourage you to have targets that are 5 to 6 months out, as we will be in a carry market until there's a major change in supply and demand. Thank you for watching. Stay safe and have a great day.